Can you actually retire just off of one fund in your portfolio? Theoretically, it could be possible, and if it is, then why does the investment community always turn to popular investment styles like the 2-fund portfolio or the 3-fund portfolio? Today, I'm examining the merits for having just one fund in your portfolio, because if it is reasonable, then it might actually be a simple approach for many of you out there. And if we were to buy just one fund and try to retire off of it, which fund should it actually be? So we're gonna go over that today, as well as some of the common pitfalls that investors will run into when trying to explore this strategy. All right, so to give you a little context, the 3-fund portfolio is usually consists of 3 broad-based index funds that track the overall American stock market, the overall international stock market, and the total US bond market. It's typically considered one of the gold standards of investment approaches, especially according to the Bogleheads investment community online, because of its broad diversification and simple approach. The 2-fund portfolio is really similar. It consists of 1 stock fund as well as 1 fixed income fund, and so that way you can choose US equities or international equities within your stock fund, or a little bit of both, as well as you have the fixed income side. Either way, a 2-fund portfolio is also going to be diversified as well, but it has 1 fewer fund than the 3-fund portfolio, so it is a little bit more simple. And then, my friends, there is the 1-fund portfolio. That's where you just go all in on 1 fund. And this seems a little bit too simple and straightforward for newer investors as well as advanced investors out there, because they think to themselves, man, only 1 fund? It seems a little bit too easy. Usually the assumption is with investing that it's very difficult and complicated, and oftentimes that's why I see people usually writing into me with 5 or 10 ETFs within their portfolio, but sometimes that's not a great thing. Now, I am happy to report that you can actually just invest in 1 fund and retire off of it. Now, which one of these funds should you actually invest into? There are a few candidates for selection. Typical candidates for a 1-fund portfolio include choices such as target date funds. Those are the ones that are usually in your retirement accounts. You can also choose a singular ETF that has a mix of equities and fixed income within the ETF itself. And some ETFs actually invest in multiple other ETFs, and they're more of a fund of funds, if you will. First, let's go over the mechanics of a target date fund. A target date fund is simply something like the Vanguard 2025 Target Date Fund. The year 2025 refers to the year in which you, the person who's buying the fund, expects to retire whenever they hit retirement age. In the beginning, a target date fund holds mostly stocks for growth, and then as you age, it reduces the risk by adding more bonds and cash, so that by the time you retire, your portfolio mix might be closer to a 50-50 split of stocks to bonds. Target date funds have been around for quite some time, and they're usually available in your 401k or your retirement plans, and many people are known to just all in a single target date fund and then forget about it. We're going to talk about how their performance is rather shortly after I go over the specifications for the other 2 candidates. The next candidate for a 1-fund portfolio is going to be something like Vanguard's Life Strategy Moderate Growth Fund, which is ticker symbol VSMGX. It's a fund that invests in 4 other Vanguard funds, and it's roughly comprised of a total mix of 60% stocks and 40% bonds. And another example of this is BlackRock's iShares Core Growth Allocation ETF, that's ticker symbol AOR, and that holds a mix of 7 different ETFs, totaling a total asset allocation mix of 63% in equities and 37% in bonds. Now, even though historical returns aren't an indicator of future results, we can still see that both VSMGX and AOR performed about 7.5% in returns since their inception. And across the last 10 years, we can see that they've performed about 6%. Now, the target date fund is rather similar, but by the results, we can see that it is a little bit weaker. Investors searching for more aggressive returns might prefer Vanguard's VTI or index fund VTSAX, which is the entire US stock market, about 3,700 stocks. VOO, more commonly known as VOO, is also a very popular pick, which is Vanguard's S&P 500 ETF. You can see both VTI and VOO have been outperforming the former funds by quite a bit, and even when compared to the popular Bogleheads 2-fund or 3-fund portfolios, they tend to outperform like crazy. VOO is up 29.83% in the last year alone versus the 3-fund portfolio, 13.05%, for example. But of course, with all those returns comes more downside risk as well as volatility on any given year, and if you are an investor that gets emotional or a little bit nervous about the ups and downs in your portfolio, then you may not want to get involved in this strategy. Another situation that can get you a little bit nervous are financial advisor fees, and that's where today's sponsor, Facet, can help. Financial advisor fees are kind of like road trips, so let me explain. Say you're planning a road trip and there are 2 different types of car rentals. One charges a fee based on the distance that you drive, and the other charges a flat fee for unlimited miles. Which one would you choose? This scenario actually relates a lot to financial advisors and their fees. The percentage fee advisor is like the car rental that charges you based on mileage. The more miles you drive, the more that you're going to pay, and similarly, the more that your investments grow, the more you pay in fees, even if your advisor's efforts are the same. Now, a flat fee advisor is like the rental with unlimited miles. You pay a fixed fee regardless of how far you travel or how much your investments grow. It's like having the freedom to drive as much as you want without worrying about additional costs based on your mileage. Facet is a company that offers a flat fee membership for all of your financial planning needs, including investment management, so you know what you're paying for up front regardless of the performance of your investments. In that way, it's like a flat fee rental car. The other benefit, they're all CFP professionals that are fiduciaries, which means that they are legally bound to have your best interests at heart rather than trying to sell you investment products to make a commission. The team at Facet doesn't charge any commissions, and they're backed by a team of experts providing guidance on estate planning, tax strategy, and more. If you're serious about getting your financial plan together for the rest of your life, I highly suggest you go check out facet.com/Humphrey to see which membership is right for you. Huge thanks to Facet for sponsoring this portion of the video, and let's continue. All right, so back to volatility. Pretend you want to go all in ticker symbol VOO. You would have to be comfortable with those swings because in the down years, you're gonna lose a lot more money. If you were just invested in VOO in 2022, from January 4th to October 12th, you would have seen a drawdown or a negative return of 24.52%. Imagine your portfolio was just $1 million at the start of the year, all in VOO. By the time October 11th rolled around, you would have had $760,000 in your balance, or a loss of $240,000. That type of volatility could really make you question your ability to invest, and you might actually panic sell or emotionally do something you shouldn't be doing. The 3-fund portfolio, on the other hand, had a drawdown of minus 18% in 2022, so while still not great, at least it wasn't as bad as just going all in on VOO. So I hope this illustrates that while some of these ETFs can really produce outsized returns during the great years, it can really produce outsized downswings as well, and so sometimes if you don't want that volatility, you can go with a 2-fund or 3-fund portfolio instead. We can actually look at the graphs of volatility of the 2-fund and 3-fund portfolios to see how well it stacks up against the benchmark S&P 500. So this chart shows the rolling 1-month volatility of the 2-fund portfolio against the benchmark, and then the 2-fund portfolio you can see here is less volatile across the board due to its broad diversification. The 3-fund portfolio is similar. You can see that the volatility of the 3-fund portfolio is consistently across the board below the benchmark of the S&P 500. Now, you're probably wondering, if you've gotten to this point, okay, I'm just sick of all the information. Just tell me what fund to buy, Humphrey. First of all, I can't tell you what fund to buy, but I will tell you what I personally would do if it were me. If I were choosing one fund to go with and I was on the younger side, I would probably just choose VTI. The returns are about the same as VOO, plus you get the added diversification of having small caps in the mix, and so the total holdings of VTI are 3,717 stocks. If you're especially bullish on the United States as a whole, this is the one fund that is probably good for that, as well as the one fund that you could solely retire off of. Now, does this mean that you should just go out there and buy VTI just because I think it's the best for me if I were on the younger side? No, you should definitely do your own research and really research whether or not that is a good choice for your own risk tolerance and your own time horizon. As you get older, you might actually want to shift your priorities. You might actually want to shift your asset allocation, because as you get older, you want to reduce the risk that you have. And so at that point, you could sell one fund such as VTI and switch it to another that is a little bit more conservative. Now, don't forget, whenever you do switch funds, you need to consider the tax implications of doing so. If I were a little bit older and had to choose one fund, I would probably go with a Boglehead one fund recommendation, such as the Vanguard Life Strategy Moderate Growth Fund that we talked about earlier, that's ticker symbol VSMGX, or something like the BlackRock one that we talked about earlier, ticker symbol AOR. If you want further reading on the subject, you may want to consider reading the entire mega thread that is on the Boglehead's investing forum, and I will link that down below in the description for you. All right, so I wanted to share a note on target date funds as well, because when you're buying a target date fund, let's say you want to do that and set it and forget it, you actually have to consider what account that you're buying it in. Target date funds should be primarily bought in a retirement account, such as a 401k with tax advantages. The reason being is that you could get hit with unexpected taxes if you're investing in them in a taxable account. This New York Times article reported that one California man was hit with an unexpected tax bill of more than $70,000 in 2022 for holding target date funds in a taxable account. That's because target date funds produce taxable income from a few different sources. Quote, interest income from bond holdings, holdings, dividends from stock, and taxable capital gains distributions. These capital gains will get sometimes passed to the holders of those target date funds, and that's something that you might be on the hook for, especially if you're investing in a target date fund within a taxable account. So if you are going to do the one fund portfolio approach with a target date fund, just make sure it's in a retirement account. All right, so now that you have all of this information, what is like the TLDR? Okay, so I think that the one fund portfolio really solves for three major problems when it comes to investing. Number one is simplicity. Even experienced investors that I talk to really value simplicity of having just one fund in their portfolio. And the other nice thing about having one fund is that you can set it and forget it and you don't have to do any rebalancing. Number two, no temptations. Because there is only one fund in the portfolio, it's not like you have to switch out your holdings from time to time. The bogleheads love to call these temptations behavioral pitfalls, and these are all pitfalls that we as investors make, and there's a whole list of them on the bogleheads forums. For example, paralysis by analysis. Quote, "We have thousands of funds to choose from and an abundance of market noise telling us what we should do. The more choices we have, the harder it is for us to choose one, making it more likely we will not make a choice at all and will fail to invest." And I see this in my own life when I'm talking to my friends. Some of them are overwhelmed with investing. They're simply not going to invest at all because of all the options that are out there. And oftentimes I need to walk them through how to invest over their shoulders, or else they're not going to do it. I don't mind doing that, especially when they're offering me some sort of dinner compensation for helping them invest. I always like to default to sushi. I love tamago nigiri, so good. But anyways, that's the best part of the one fund portfolio. You don't really have to think too much. The third major problem that the one fund portfolio solves for is the problem of over diversification and overlapping when it comes to buying too many funds. So one common issue I see with beginner as well as advanced investors out there is that they often buy 2 or 3 ETFs for funds, and they often will overlap in their holdings. Say you buy the popular QQQ ETF that tracks the NASDAQ 100, but you already hold VTI, which is the Vanguard Total Stock Market Index. The problem is that when you buy QQQ, but you already own VTI, 93% of the holdings that you're buying QQQ of, you already own them within VTI. So now you're buying 2 funds, but you're literally buying the same holdings just in 2 different places. So this website, ETF Research Center, I'm gonna link it down below, allows you to compare 2 funds together to see how much overlap there is between 2 funds that you choose of. And if you're investing in multiple funds, I'd strongly recommend playing around with it just to make sure that you aren't overlapping too much. Some overlapping is going to be inevitable, especially if you're buying 2 ETFs in a similar type of category. However, you just really want to figure out where you're too concentrated or not as concentrated in whenever you have these 2 funds. This especially hits even harder if you're trying to buy individual stocks, if you want to add individual stocks to your portfolio. But for example, if you bought QQQ and VTI and they both had a bunch of Apple stock already, then for your individual choices, maybe you don't want to buy more Apple stock because then you're just going to be super heavyweight in Apple stock. So I definitely think that having one fund in your portfolio is definitely going to be a lot easier and less stressful. You're not going to be waking up right before the market opens, checking to see how it does. And that way you can have more time to spend on things that you actually want to do, like making more money in your job, perhaps going golfing, going shopping, eating sushi, etc. Compared to the 2 fund or the 3 fund portfolio that we talked about in this video, it is a more simple strategy than those, but it is still pretty comparable depending on who you are. I personally always like to think of investing as a passive endeavor. So any portfolio that allows you to just kind of set it and forget it and let you compound those returns while you focus your active time doing other things like making money, like I said earlier, that's going to be very solid. All right, I hope that you enjoyed this video. Let me know down below if you are going to do a one fund portfolio, if you already do a one fund portfolio, or what your general thoughts are about going all in on one fund. If you want more information about the 3 fund portfolio, check out my video right here. I go into the exact investment strategy behind it, as well as how to rebalance it. I hope to see you guys in that video, or perhaps a next video on this channel. Thank you for being here. All right, peace.